Today, the investor's dilemma: hang in or jump out. Hello again, it's Martin North from Digital Finance Analytics One-Day's Post, covering finance and property news. And this is our weekly market update. It's the best way I've found to organise my thoughts for the week and to track what's been going on. We'll start in the US, across to Europe, then Asia and Australia, and we'll also cover commodities and crypto. In the US, the Nasdaq eked out a fifth straight record closing high on Friday, following gains in Adobe and other technology-related shares, while the S&P 500 and Dow ended slightly lower. The Dow Jones Industrial Average fell 0.15% to 38,588. The S&P 500 lost 0.04% to 5,431. And the Nasdaq Composite added just 21 points, or 0.12%, to 17,688. For the week, the Dow was down 0.5%, the S&P 500 rose 1.6%, and the Nasdaq was up 3.2%. So the S&P 500 ended its four-day run of record closing highs, but still climbed more than 1% for the week. The S&P 500 technology sector rose 0.5%, hitting another record high close, and the communications services sector rose 0.6%, leading gains among the sectors. Adobe shares jumped 40.5% a day after the company raised its annual revenue forecast on more demand for its artificial intelligence-powered software, but the Russell Small Caps Index fell 1.6%, adding to recent losses, while the S&P 500 industrial sector was down 1%. The big issue this week was the Fed's post-decision press conference, with investors still trying to gauge how soon the Federal Reserve might be able to cut interest rates following Wednesday's cooler-than-expected CPI report and the Fed's revised dot plot, which lowered rate expectation cuts this year from 3 to 1. See my earlier show where we discussed the data-dependent higher-for-longer Fed stance. Though some in the financial media celebrated the fact that the CPI showed no monthly increase in May, that doesn't mean consumer prices have stopped rising, of course. On an annual basis, the CPI is still running at about 3.3%. Fed Bank of Chicago President Austin Goodsby said he was relieved after data this week showing inflation in May had cooled, but he would still like to see more months of similar data before cutting interest rates. US economic data continues to confuse also. Unfortunately, for those who seek the truth about the US economy, the non-farm payroll report has become a bit of a farce, despite a deluge of labour market data that clearly shows that hiring is slowing down significantly, such as the jobs opening and labour turnover survey, which is at a 3-year low, negative labour market index in the ISM services sector, rising initial jobless claims, and a parade of public companies announcing layoffs and hiring freezes, the BLS came up with a headline number of 277,000 net new jobs hired in May. This is despite the unemployment rate ticking up to 4%, the labour force shrinking by 250,000, and the household survey showing an actual decline of 408,000 jobs in the same month. The difference between what actually people are saying in their employment status derived from the household survey as opposed to the establishment survey was a whopping 680,000 jobs. And the household survey also showed that the number of full-time employees shrank by 625,000, while the number of part-time workers increased by 286,000. In the past 12 months, the non-farm payroll number has risen to 2.75 million. However, the number of full-time employees is down 1.16 million. So talk about diametrically opposed data. And it's imperative to note that the household survey always leads the trend in the establishment survey. Nevertheless, the Fed is going to be held to the headline number from the BLS because they are, of course, labour market economists and Phillips curve adherents who believe inflation comes from too many people working. Hence, the Fed's hands are tied regarding rate cuts released the next few months. That means this report slams the door shut on both a June and July rate cut and delays rate cuts until at least September and probably into next year. And by the way, a report on Friday showed that the preliminary reading of the University of Michigan's Consumer Sentiment Index slipped again to 65.6 in June, sharply lower than expected. Additionally, the yield curve remains deeply inverted, meaning short-term debt yields are more than longer-dated bonds. This is a further disincentive for banks to be exposed to so-called duration, or the interest rate sensitivity of their positions. After improving at the end of last year as Treasuries rallied on expectation of interest rate cuts, liquidity has worsened over the past few months as the US Treasury continues to issue large amounts of debt to back deficit spending, while dealers struggle to keep up with the ballooning size of the market. 10-year was down this week to 4.222%, while the 2-year was at 4.707. The trend in equities is now actually largely decoupled from everything, whether you look at macro data or indeed other assets, but continues to outperform thanks to the technology sector, particularly artificial intelligence. We know that Nvidia has been up 155% year to date, and its market cap is over $3 trillion. The company just gained the equivalent of Amazon in the last 6 months, and it's responsible for just over half of the S&P 500 gains this year. For comparison, the equal weight S&P is up just 4% over the year. All previous stock market bubbles share the following in common: a narrow stock market rally that focuses on a small group of stocks in a small sector of the economy that Wall Street is working overtime on promoting. AI fits this profile perfectly. So investors are caught. They don't sell for fear of missing opportunities and don't buy for fear of a crash. And overall uncertainty is increasing. It's deer in the headlights time. Perhaps no wonder then that US equity funds observed heavy outflows in the 7 days through June the 12th, as some investors booked profits and exercised caution ahead of the Federal Reserve's policy decision. Investors ditched US equity funds worth a net $21.93 billion during the week, in their largest weekly net disposal since mid-December 2022, according to LSEG data. Conversely, investors sought safety in US bond funds and money market funds. Now, the Fed, of course, will be cutting rates too little and too late to prevent a sharp slowdown in the economy. There's nothing new here because the Fed always acts ex post to the start of an economic contraction, because the headline figure from the NFP report is a lagging economic indicator. Mr. Powell will not be proactively reducing rates ahead of the recession, but then will be forced back into zero interest rate policy and quantitative easing once the employment rate begins to spike. The truth is, the Fed has saddled the US economy into an endless roller coaster of boom and bust cycles. Unfortunately, this means the economy should experience a protracted and acute period of stagflation, much worse than what was witnessed in the wake of the pandemic, once the recession begins and the financial system is again saturated with a deluge of helicopter money. Elsewhere, gold has generally drifted sideways for a couple of months now, consolidating from highs. Back in mid-February to mid-April, gold blasted a powerful 20% higher in a remarkable breakout surge. Fully 19 new nominal record closes were achieved in that short span, which really excited traders. The lion's share of that upside wasn't fueled by gold's usual primary drivers, speculators buying gold futures and American stock investors buying gold ETF shares. No, Chinese investors and central banks have taken the helm. But since the start of the week, gold has twice pushed off support at around 2,300 US, but this support looks extremely fragile and unreliable. Firstly, last Friday, gold went over 4% from peak to bottom on high volumes and with a horrendous amplitude falling under the 50-day moving average. All other dynamics this week may well be considered as consolidation of liquidity by bears for a new blow to the metal. This thesis is reinforced by the fact that the 50-day moving average is already actively working as resistance. The futures was last at 2,348. And secondly, the dollar has been rising since last Friday, as if switching into a buy in the downturn mode. The dollar index has pushed back from its 200-day moving average since the beginning of the month, and a rising dollar with attractive bond interest yields makes dollar bonds an effective competitor to gold. The DXY was last at 105.22. Oil was mid-range this week, with WTI at 78.50 and Brent at 82.62, caught between higher supply and weaker demand. Some analysts are now picking rates as low as $60 a barrel US, but we'll see. In Europe, Politics are impacting markets. Britain's economy might well have fallen into recession late last year, but the prospect of a changing government that lifts sentiment towards the economy has seen investors debating whether UK markets are too cheap. An expected victory by the EU-friendly opposition Labour Party may lift sterling, while regardless of the election outcome, looming rate cuts should lend support to government bonds known as gilts. 10-year gilt yields, which rise as their prices fall, are around 4.1%. They've soared 52 basis points so far this year, while German and US peers are up just 30 basis points. Britain's national debt is almost 100% of GDP, and Finance Minister Jeremy Hunt has hinted in pre-election tax cuts in his March budget, prompting a warning from the International Monetary Fund. That's a reference to a market rout in 2022 after a largely unfunded mini-budget and tax cuts by their then Conservative Prime Minister Liz Truss's government sparked a surge in borrowing costs and mortgage rates, shattering Britain's reputation for financial stability. Sterling's gained around 2% against the euro this year, and speculators hold one of their largest bullish positions in the pound of the last decade, but it has lost ground against the stronger US dollar. But then, UK stocks are unpopular, trading at a 35% discount to global peers, with this valuation gap near its widest in decades. Before 2016, UK equities traded a premium. Just over $36 billion flowed out of UK equity funds in 2023, almost triple the amount lost in 2016, and the most since at least 2008. That's according to fund tracker Morningstar. The UK market is cheap, but everybody knows that. And what everybody is waiting for is a catalyst to get involved. And once that starts to rebound from here, could be huge. On Friday, the FTSE was down 0.21% to 8,146. Now in Europe, economic data remains mixed, with data released on Thursday showing Spanish consumer prices growing 3.6% on an annual basis in May. That's a jump from 3.3% in the prior month. By contrast, German wholesale prices fell by 0.7% in May compared with the same month last year. But French stocks and the euro have tumbled this week as political uncertainty in France and the possibility of a far-right dominated parliament spooks investors, while the gap between French and German government borrowing costs have soared. Marine Le Pen's Eurosceptic national rally is leading in opinion polls following President Emmanuel Macron's surprise decision late last weekend to call a snap vote, while France's left-wing parties have formed a new alliance to fight the election. The worries for markets is that a far-right French prime minister could pursue high-spending France first economic policies, adding to the country's large debt pile. Some investors have started to talk of the risk of the Eurozone breaking up, although that remains a way off. French stocks have sold off hard. The blue chip CAC 40 is at its lowest since January, having shed 6% this week, its biggest weekly drop in over 2 years. Mid-caps, which typically have more exposure to the underlying national economy, are down 9%. That's the biggest weekly drop since March 2020 pandemic's turmoil. The DAX in Germany was down just 1.34%. Banks have been particularly hard hit, with BNP Paribas, Crédit Agricole and Société Générale all down over 10% this week, losing roughly $19 billion in market cap since Friday's close. That's based on LSEG data. French government bonds are also under pressure. The difference between the French and German 10-year borrowing costs rose to 78 basis points on Friday, the highest since 2017, not seen since the Eurozone crisis of 2012. The spread reflects the premium investors' demand to hold French government bonds rather than German bonds, the Eurozone benchmark. Spreads are also widening due to a general rush for safe haven assets in Europe, and that includes German government bonds. The yield on the German 10-year bond was down 24 basis points, and that's the biggest weekly drop since December. The euro dropped around 1% against the dollar, the British pound and the Swiss franc this week, and is at its lowest against the pound in almost 2 years. Markets are braced for further sharp moves. 1-month options volatility for the euro against both the dollar and the pound has jumped to its highest in over a year. Now in Asia, most Asian stocks fell on Friday as a rally on signs of cooling US inflation wound down, while Japanese shares rose after the Bank of Japan surprised markets by signaling no near-term changes to its bond buying program. Chinese markets were the worst performers for the day, hit by new European Union tariffs against the country's major electric vehicle makers. Fears of retaliatory measures from Beijing also dampened sentiment. Japan's Nikkei 225 and the TOPIX indices rose 0.3% after trading sideways for most of the day. The Bank of Japan kept interest rates steady, as widely expected, with its benchmark short-term rate at 0.1% after that historic hike in March. But the bank surprised markets by enacting no near-term changes to its bond buying program. Instead, the Bank of Japan said it would meet with market participants and unveil an elaborate plan to begin cutting bond purchases at its next meeting at the end of July. The move indicated that Japanese monetary policy will remain relatively loose in the near term, a trend that bodes well for local stock markets. Yields on government bonds fell on the news, while the yen hit one-month lows against the dollar at 157.38. Markets were doubtful over the Bank of Japan's capacity to tighten policy, given recent signs of weakness in the Japanese economy, and the central bank also offered no clues as to future plans to raise rates. China's Shanghai Shenzhen CSI 300 fell 0.4%, while the Shanghai Composite Index actually rose 0.12%, while Hong Kong's Hang Seng lost 0.94%. The Chinese exchanges saw extended selling after the EU imposed steep tariffs of between 17 and 30% on the import of Chinese electric vehicles, and SIAC Motor Corp was the worst hit, facing the steepest trading duties among its peers. The EU trailed the US in imposing tariffs on China's fast-growing EV sector, but unlike the US, the EV does represent a major market for Chinese EV makers. The tariffs ramped up concerns that the EU and the US could impose more restrictions on Chinese imports, while Beijing could also announce retaliatory measures, denting relations between the world's largest economies. A new bank lending in China rebounded far less than expected in May, and some key monetary gauges hit record lows, suggesting the world's second largest economy is still struggling to regain its footing, even as the central bank seeks to bolster confidence. Chinese banks issued 950 billion yuan in new yuan loans last month, compared to 730 billion yuan in April, according to Reuters calculations based on the latest data from the People's Bank of China, which was released on Friday. Chinese stocks have been on an uptrend since early April, delivering over 10% returns in US dollar terms. Major indices like the MSCI China, the Nasdaq Golden Dragon, and CSI 300 have all rebounded sharply from their late January lows, gaining nearly 27%, 22%, and 14% respectively. But according to the UBS strategists, there are multiple factors driving the strong performance of Chinese stocks. Specifically, first quarter macroeconomic indicators exceeded expectations, and the economic and regulatory policy tone has been more supportive. In April, guidelines addressing investor concerns around minority shareholder interests and listing quality were released. And also in April, the Politburo meeting signaled intentions to tackle housing inventory issues, leading some analysts to anticipate more aggressive supply-side property stimulus. The mix of catalysts has modestly reignited investor interest in Chinese stocks, despite historically light positioning and a mixed global backdrop, UBS said. In our view, the China stock rally has run ahead of a narrow macro recovery and lackluster corporate earnings outlooks, strategists noted. Property-related indicators continue to trend downwards, which will likely weigh on consumer sentiment. And as a result of weak demand, deflationary pressure has so far persisted, they said. Moreover, UBS notes that the downgrade in 2024 consensus earnings growth forecasts may have further to go, adding that the first quarter 24 results season is likely to underwhelm market expectations. We think Chinese stocks offer limited upside in the near future, and we are not confident that they can outperform emerging market peers, they said. Elsewhere, India's Nifty 50 index rose 0.29% to a high of 23,465 as the political uncertainty post the election settled down, and South Korea's Kospi rose 0.13% on some sustained strength in technology stocks. Now, in Australia, there was a broad sell-off that sent Australian shares to their third loss in 4 days on Friday in a holiday-shortened week, missing out on Wall Street gains that retested recent record highs. In the week's final session, the ASX 200 lost 0.33%, or to 7,724. For the week, the benchmark lost 1.7% as broad falls in commodity prices dragged miners lower across the board. It marked the worst week on the ASX since mid-April, and the ASX industrial and utility sector also ended lower. The best performing business on the S&P ASX 200 on Friday was gambling giant Tabcorp, which rose 10% to 65.5 cents after the New South Wales government said it would review wagering laws in a move that could lead to increases in the amount of tax paid by rivals such as Sportsbet and Entain. The worst performer was mining royalties business Tatara Royalties, which tumbled 7% to $4.15 after making an all-cash offer for AIM-listed British lithium mining group Trident Royalties worth about £140 million, or $276 million. Elsewhere, Telix shares rose 0.9% to $16.61 after the biotech said it would cancel its planned US initial public offer at the last minute. And shares in ASX Limited extended losses to 56.45 after a weaker than expected trading update on April sent the shares in the exchange operator tumbling 8%. Opthea announced on Friday that it completed a $171.5 million capital raising offered to institutional investors. The eye therapy developer will also launch a fully underwritten $55.9 million offer to retail investors. Shares fell 24.7% to 37 cents. The banks were a little weaker and I think are overvalued, as the government announced on Friday evening that they will cover off on several of the ACCC's recommendations, where banks will be required to notify customers when their rates change on transaction and savings accounts. Banks will need to tell customers when their savings interest rates change, and the process for switching home loans will be simplified under the new federal government push to help consumers get better deals. The government will also require banks to offer clearer information about the different types of deposits they offer. The move follows 2 banking reviews by consumer watchdog the ACCC, one on savings from 2023 and one on loans from 2020. The employment data this past week will do little to influence the RBA's next decision, which is coming next week, as we discussed, higher for longer. And the Australian Securities Exchange has approved its first Bitcoin exchange-traded fund, marking a major step forward in the growing availability of cryptocurrencies to Australian investors. The Van Eyck Bitcoin ETF will list on the ASX on Thursday under the ticker VBTC, marking the first on the exchange that tracks the price of Bitcoin, the most widely held and actively traded cryptocurrency. Van Eyck's Asia Pacific Managing Director, Aaron Neran, said he recognized that investing in cryptocurrencies was a polarizing topic, but that Bitcoin remained, quote, an emerging asset class that many advisors and investors want. We have developed a robust offering that we believe provides an opportunity for Bitcoin exposure using a regulated, transparent, and familiar investment vehicle, he said. And the ASX said, we had interest off and on about listing a crypto ETF going back the best part of 5 years. We got reasonably close to having one 2 years ago, just before the crypto winter started. But with the recovery of cryptocurrency prices, we had a fair bit of interest over the past 12 months, and it's culminated in the approval. The approval arrived almost 6 months after the US Securities and Exchange Commission approved a suite of 9 Bitcoin ETFs to list in the US. And continuing the crypto theme, Bitcoin prices dropped slightly on Friday as forecasts of fewer interest rate cuts by the Federal Reserve saw traders pivot largely into the greenback. Bitcoin was last at 66,117 US, although the token had fallen as far as 66,000 on Thursday, as the dollar rebounded sharply from 1 month lows. Meanwhile, the largest public corporate holder of Bitcoin, MicroStrategy Incorporated, plans to buy more Bitcoin by issuing $500 million worth of bonds. But that's failed to spur much price action too. The world's biggest cryptocurrency was trading down about 3.3% over the past 7 days, as angst over higher for longer US interest rates dented the outlook for crypto. Broader cryptocurrency prices moved in a flat to low range as concerns over high interest rates largely offset some positive developments towards a spot Ether ETF. In fact, Ether rose 0.3% to 3,531 and was one of the few altcoins trading positive. Securities and Exchange Commissioner Chair Gary Gensler said in a testimony before the Senate that he expected spot Ether ETFs to be fully approved by the regulator by the summer. But that said, Bitcoin ETFs witnessed net outflows of more than $226 million on Thursday, marking the third consecutive day of withdrawals this week, reminiscent of the outflows at the end of April. But not to be outdone, Michael Saylor, chairman of MicroStrategy, who has been a vocal advocate for Bitcoin, said in a speech that everyone gets Bitcoin at the price they deserve. Saylor made a bold prediction. When Bitcoin reaches 950,000, many will still wait for it to drop to 700,000 before buying it. However, he implied that such hesitation could result in missing out yet again, as Bitcoin might then skyrocket to $8 million. This prediction highlights Saylor's belief in Bitcoin's long-term value proposition and its potential to appreciate significantly over time. The idea of Bitcoin reaching 8 million may seem far-fetched to some, but it does align with Saylor's broader perspective on the asset. He views Bitcoin as a superior store of value and hedge against inflation, with the potential to attract significant capital from traditional assets. Well, we'll see about that. Anyway, next week, among the highlights will be the RBA policymakers meeting on Tuesday, the Bank of England policy meeting on Thursday, and Swiss and Norwegian central banks also hold policy meetings on Thursday. And China's also scheduled to release May industrial production and retail sales next week too. But standing back, you can see here that we are in a highly brittle environment. Markets are fragile. The prospect of higher rates for longer still haunts, and yet markets are also being supported by a very narrow base of enthusiasm around AI. Something's got to give. It's just a matter of when. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.